Let's go ahead and get this puppy started. Thanks for joining us, everybody. I have with me Jeremy Dorn, Relationship Manager at Core. He will be helping us explore the vital discussion, why you shouldn't use a budget. So before we get started, I have a poll question that I want to push out, and just to get a feel for the group. Basically, what's your experience with budgets? Let me know what you guys have tried in your business, not at home. That's a different thing. Budgets are great at home. It's kind of like Dave Ramsey. You know, everybody loves Dave Ramsey. Dave Ramsey is great for your personal finances. A lot of things he says just don't work for me in business, and that's kind of the same thing with budgets. So here are the results. Looks like most have not tried or tried it and didn't work. Nobody, surprisingly, said, I love spreadsheets and budgets are awesome. I actually think that Jennifer would have maybe said that she loves budgets, but
I'm going to say Jennifer's definitely not on this call then, for sure.
That's exactly right. So no, that's exactly right. So let me hit get the tech going here and hit the slide. This is me. This is Jeremy. Jeremy's got a newer picture than I do, and therefore he looks better. I am fat in that picture, and I need to get it updated. So since most of you have either not tried a budget or tried a budget in your business and it hasn't worked, let's talk about what is a budget. And I discovered this a couple of years in talking to clients, this myth about budgets that most people have, because most of their experience is from personal budgets where, you know, there's pretty much a fixed amount coming in, and then it's just, well, how do we make sure we don't run out of money? In a business environment, that usually the only companies that use budgets and use them the way they're intended and the way they work is large enterprises that have processes in place to control, because a budget at the end of the day is about expense control. And the problem with small businesses is that you as the business owner are in control. So, you know, if you can't control yourself, a budget's not going to help you. And if you don't have anybody in your business approving checks or approving bills or writing checks, paying bills, there is no control. So a budget in its simplest terms is to make sure that the money's there to spend. So if you think about it, you think about a large organization, you've got all these people, they don't get to write checks. They have a budget that they have to live within, and then they submit their invoices and expenses to get paid. And then somebody else looks at the budget and said, yeah, that's a valid expense. And yeah, there's money there, so we'll approve it. But that doesn't exist in a small business, right? And I think one of the, you know, some of the respondents said that they've tried budgets and they haven't worked. And I think that's what's really disheartening about budgets is most business owners think that if they can follow a budget, that they'll have financial success. And it gets very frustrating when they try to use a budget and it doesn't work. And they're like, well, you know, what's the point? Jeremy, what's your experience with clients that have tried to use budgets?
Yeah, I think it comes down to the setting yourself up for success, right? Budget is like this word that everybody thinks of that is going to solve your financial problems, and everybody talks about doing a budget every year. But somehow, 2 or 3 months into the year, nobody talks about budgets anymore because they're probably blown or they're probably just failing, right? So it's this great buzzword in December and January, and then it just kind of goes away for the rest of the year, most of the time.
Well, in full disclosure, I mean, here at Core, for years, we did budgets because we thought the same thing, right? I mean, it was like, and we had that exact experience. We'd be 3 or 4 months into it and nothing was going to plan. And it was like, well, the rest of this budget is completely shot. I mean, there's no use using it because it's obviously not going to be right. and then what's the point? What's the use?
We'll just do better on next year's budget. It'll be fine.
Right.
We'll do
Right.
next year's budget will be better.
Right. And I can't stress enough the mental drain that puts on the entrepreneur, because they feel like a failure. Like, my budget's blown. I'm never going to make financial success. It's like, it's frustrating. I kind of hit on these points of why budgets fail. But I think it's very important to point out that, there is no control in the organizations besides you. Your name is on the checking account. So if you might have employees that have credit cards and those things, and you can control those to a certain extent. But as far as using a budget, you're not going to tell yourself, no, I can't spend it because it says the budget says I can't, right? The second item that we didn't cover is that the budgets are not always grounded in reality. There's a lot of assumptions that go into a budget about what's going to happen. And you can put a lot of planning into a budget, but what happens when things don't go as planned, right? You need a tool that is flexible, that can change as the results actually come in, as it were. So we're going to give you a couple of alternatives to budgets. The first is Profit First. And this webinar is not about Profit First. We've done webinars on Profit First, and be happy to answer questions here if you have questions. But just to show you as an alternative to budgets why Profit First makes sense, and then some of its limitations. So Profit First is a process designed by Mike Michalowicz and Ron Saharan. And it basically follows this old envelope system that your parents made, or your grandparents may have used, where they would cash their paycheck. They'd have an envelope for food, an envelope for rent, an envelope for, entertainment. And they'd put, a certain amount in each envelope every paycheck. And when the money was gone, that was end of it. And Profit First follows a similar concept in splitting your money into different bank accounts, which act kind of like those envelopes. And it does give you some control process, but it really, where I see it fall short is when the owner doesn't have the discipline. And let's face it, I mean, you have a limited amount of brain power as an entrepreneur, and you can only discipline yourself a certain amount before you start just going nuts. What I find Profit First does is it does give you a tripwire. So, if you're having to move money back from your profit or your owner's comp or your tax account to pay expenses, then, you've got to at least make that transfer. And so you get that additional opportunity to question whether you're doing the right thing. So Jeremy, with your clients that use Profit First, how do you see that working instead of a budget? Is that an alternative that works for them?
Yeah, I mean, I've had several clients that started Profit First, and every client's a little bit different. So we've got some clients that start out Profit First on a more like basic level, just opening like a profit account, maybe a tax account. But it's about creating those habits. It's also about having smaller plates. So it's really, if you've got smaller plates to spend from, then that hopefully brings your spending down. But I think that the habit that I've seen with clients is they'll create like a profit account, and I'll tell them just to start doing 1-2%, whatever, into that profit account. And they'll see that grow, and that kind of starts getting them excited. Like, whoa, after a couple months, there's a couple $1,000s there. Wow, that's awesome. And they're not having to transfer it back. So, I mean, if you are having to transfer it back, like you said, the tripwire thing, it can be very like, why am I transferring this money back? I don't need to, like, this is profit, right? So if it's profit, then it should be profit, and it should be being cleared every quarter. So those plates stay small, because we all know if you've got one big bank account, it's got $50,000 in there, and you've got a bill in front of you for $20,000, whether or not you need it, you're going to go spend it, right?
Right. And I think that's a great point that, the small plates is a concept Mike talks about, but I also like the whole out of sight, out of mind. And that profit account is you're not supposed to have it at the same bank, and you're not supposed to have online access to it, so you can't see it. And that is one of the great results of using Profit First is after that quarter, you open your statement, or you go and go to the physical location of the bank and say, oh, wow, I've got several $1,000s here. That's great. So yeah. Anything else on Profit First, Jeremy, that you think is applicable here?
No, I think we covered most of it.
Okay. I will let you know that whether you're a client or not a client, we will be happy to give you Profit First University access. If you're a client, it's free. If you're not a client, you can have it for a limited time for free. But it is a series of video courses that go into more depth about Profit First and how to do it. If that is of interest to you, I will put our email addresses again at the last slide. You're happy to email either me or Jeremy and request that, and we'll get you set up for it. So the bulk of this is this presentation is going to be on what I like to call forecasting. And the difference between forecasting and budgeting is forecasting is taking your business assumptions, your business goals. So you're planning for 2022 and you want to grow your revenue this amount. You want to open another location. You want to buy a piece of equipment to expand. You want to open another location, whatever it is, the goals that you have as a business, it starts with those. And the numbers flow from those business goals. So the key there is to not put the cart before the horse. You've got to have good business. You have to have a good business plan before you can do an accurate forecast. If you're just coming up with a forecast and you don't have any idea what you're going to do for business, then your forecast is not going to be that good. But it's grounded in the business goals. The next part about forecasting, the next benefit of it is that it's flexible. It moves with you throughout the year so that you're not having to deal with stagnant ideas. So what you thought in November and December doesn't happen in June. Well, your forecast gives you the opportunity to alter, and it's okay to change it. It's not like a budget. Well, if I'm not making budget, I'll just change the number. Well, no, that doesn't make sense. But in a forecast, it makes absolute sense, because what you're doing is grounding it in your business goals and the actual performance of what you're doing. The one downside on forecasting, which I don't think is really a downside when we're comparing it to budgets, because as we discussed, budgets don't really give business owners control, is it doesn't have anything to do with controlling spending. It's not a way to limit or control your spending. So Jeremy, you work with Core, as a matter of fact, on our forecasting. How would you describe forecasting to a client?
Well, I think forecasting is taking stuff that you know about the business, like you said, and translating it into where you're wanting to go, as you've already said. But it's really just about, it's looking at how you're going to get there, rather than just looking at, not cutting expenses, but staying within certain expenses or whatnot. So forecasting is more looking at top line and gross margin, those types of things, rather than looking at just expenses, right? Because just expenses aren't really good. That's not really, I mean, you can budget for a 10% growth, and then you can budget all the expenses, but that doesn't really tell you how you're going to get the 10% growth. It just assumes you're going to get 10% growth, right? And we all know we don't get just 10% growth by sitting at home and doing nothing, by doing a budget on a spreadsheet. It doesn't work. It doesn't work that way, right? Like you've got to, like you said, it's got to be flexible so that because you've got to have an actual plan to make that growth happen. It just doesn't happen because you talk it into existence.
You're like God. You speak and it is.
I wish it was like that, but.
So let's talk about what goes into a forecast, or how do you develop a forecast. I thought about sharing some templates with the group, but I'll be honest with you, I didn't want you guys to get buried in that and trying to figure out the spreadsheet and how to make it work. And so what I'll offer is anybody that is on the call that wants to do a follow-up, we'll be happy to help you develop a forecast, because it's not just like I can give you a template and you can fill it out, because it's not that simple. Although having a template and having it does make it quicker to do. That's the easy part. The hard part is these things, which is making sure you start with your business plan and what are your key assumptions. I've listed a few here, but they're not comprehensive. I mean, you can have different key assumptions depending upon your business and your business plan. I put on some common ones. For instance, sales. Jeremy said, well, you're going to grow by 10%. Is that your business plan? Do you have a plan to grow? How are you going to grow? Are you going to spend more money on marketing, or are you just going to grow as much as you did last year and hope that what worked last year works this year? Starting with the sales number, I think is probably the easiest for most entrepreneurs, because they like talk about growing. But growth doesn't just happen, right? You've got to have a business plan to grow. If you don't have a plan, you may grow, you may not grow, you may shrink. But starting with sales and knowing what your plan is for sales, I think is probably one of the first steps or first assumptions. The second one, and it's right on the heels, is gross margin. Gross margin is the sales minus the direct costs. Margin is a percentage. The other term is gross profit, and that's dollars. But it doesn't really matter how you look at it. It is the concept that you sell X, you have costs of Y. That may be labor, that may be product and inventory, that may be, in some cases, depreciation on a big piece of equipment. It just really depends on your business. But the concept is that for every dollar you sell, you've got an additional expense. Now, in small businesses, that sometimes is a challenge because, if you have additional sales, you don't necessarily have to go hire another person, or you don't necessarily have to get another piece of machinery, or you don't necessarily have to have more inventory. So in a lot of cases with small businesses on these forecast periods that we're talking about, short time frame of 12 months, the costs that you have in your gross profit and gross margin are fixed generally, because you're not going to change them just because sales went up or down in a month. But it's important to identify the costs that are associated with delivering that good or service, so that you can predict when you're going to need to hire more or open another location, or et cetera, et cetera. Sales and gross margin is probably, I'd say, 80% of forecast, because your overhead expense doesn't change much. I think a lot of business owners, when they think about how do I get more profitable, they start really focusing on the expense side and trying to reduce expenses. the problem with that is that you can only reduce your expenses and your overhead a certain amount. When you still got to pay the utilities, you still got to pay for the internet, you still got to pay insurance. There's only a certain amount that you can cut. Where the real juice is for the squeeze is in managing your sales and gross margin. And that takes us to the third key assumption is a labor efficiency ratio. Jeremy, I'm going to put you on the spot. What is labor efficiency ratio?
It's your labor costs, including taxes and benefits and everything else, divided into your gross margin. So it gives you a ratio of how many dollars of gross margin you're producing with the labor force that you have.
Spot on. I think a lot of people will put labor into that gross margin number, into that gross profit number, and that's okay. But pulling it out allows you to compute the labor efficiency ratio. And if you think about it, in most small businesses, if you think about your day-to-day and the decisions that you make and the impact that it can have, I don't know what percentage, but a large percentage of those decisions involve people, right? And if you can have a real clear idea of that ratio of how many dollars that labor cost is contributing to your margin, it gives you a lot of insight into your business. For instance, when we started looking at our labor efficiency ratio, we realized that we didn't really need to hire any more people. According to the numbers, our labor efficiency ratio was we didn't need to add more expense. We needed to get more out of the people that we had. And the labor efficiency ratio is a great prism to look, or looking glass or mirror. I don't know exactly what analogy I like there, but it's a good filter to look at those decisions, because I know if I had used labor efficiency ratio more sooner in my business, I would have made a lot more money. Jeremy, what conversations have you had with clients about labor efficiency ratio?
Yeah, I've had it both ways. So kind of like our labor efficiency was low, which told us that, we probably had capacity there, and it was more of an efficiency issue rather than a people issue, which is funny because at the time we thought it was some people thought it was a people issue, and we actually did hire somebody to cure this so-called people issue, which we ended up not having. And so it all kind of came to light. But I've also seen really high labor efficiency ratios with a client that would necessarily say, oh yeah, well, that's awesome that it's really high, but that just really means you're probably doing way too much of the work, right? So
Yes.
You probably have some room to hire folks to make you even more gross margin, because you're using them almost too efficiently, or you're just doing too much of the work. I mean, there's
right. Yeah, it could be that you have the capacity issue, that you could do more if you'd hire another person, or as in the case with a lot of business owners, they end up playing, utility player, and they're pitching in wherever, and all of a sudden they're doing a little bit of everything or everything, and they end up working for $50,000, because that's what it would cost to hire somebody to do all that stuff that they were doing, and free them up to be able to do more high value things for the business. Absolutely.
Yeah.
The fourth key assumption I put down here is what Greg Crabtree calls the cash power ratio. And I'm not going to go into a lot of depth on this. I did another webinar where I discussed it. I think it was last month, where I discussed this cash power ratio in detail. But the concept of the cash power ratio is how much cash does your business cost you when you grow? And it's essentially, if your cash power ratio looks at your cash flow cycle and your margin, your gross margin, and comes up with a ratio. And if it's positive, then that means that, setting aside marketing costs or customer acquisition costs, you can grow cash free. Alternatively, if your cash power ratio is lower or negative, then it means that in order to grow, setting aside your cost of acquisition, because of your cash flow cycle, accounts receivable, inventory, accounts payable, those things, you actually have to have capital, have cash to grow. But knowing that ratio for your business is uber important when doing a forecast, because the last thing you want to do in a forecast, because it's generally just the income statement, it's not the balance sheet, is that you are coming up with a forecast that shows this growth and this great profit, but you're actually going to come out cash flow negative. And that's an awful feeling, because you're in the middle of the year and you're out of money. So the cash power ratio is another key assumption. Any other key assumptions, Jeremy, that you would throw in there? I just listed 4, but
man, I think not that I can think of right off the top of my head.
Okay. So once you have your forecast, I think a really key point of using it is that you compare it to your actual numbers. And because the forecast is always rolling 12 months, it's always if you start in January at the first of the year, when January is over, you're then going to have February through January of 2023. So you're always going to have a forecast that's 12 months. Then if you lay that down next to your rolling 12 months looking back, you can actually see, and this I think is the real power of the forecast, are the things that you're doing in your business plan actually working? Are the numbers proving out your assumptions? And if your assumptions are off, that's fine. You modify them, or you find out why they were wrong. Maybe you had not all the information, or maybe some of the information you had was incorrect or incomplete. But the point is, the numbers, the historical numbers, should prove out that what your forecast predicted is working or not working. And that's to me the real juice. Jeremy, I'm going to share, and this is what I like to call I call it getting naked. I'm going to actually share our 12-month. This is not our forecast. This is how I want to show you this 12-month rolling numbers, just so you can conceptually understand it. Basically, you take the rolling 12 months, the last 12 months of your financial information for the last 3 months. So this would be February of 2021 through January of 22. This is the calendar year of 2021. And this is December of 2020 through November 30th of 2021. And then I repeat that for the 3 month. And what looking at your numbers this way does is it allows you to easily, very quickly see the trend. And it's annualized, so you don't have any of the seasonality, you don't have any of the ups and downs that you might have from month to month. You're looking at 12 months and comparing it to 12 months. And looking at it for the last 3, you can easily see, what are our sales doing? Well, our sales over the last 3 months are up $50,000 on an annual basis. Okay, that's good. Let's look at the plan. Okay, what was the forecast? Is it in line with what our forecast said? The 3 months is a little more short term. So you are going to have seasonality in there. Like in our business, December is an awful month and January is not much better. So, the fact that revenue is going down in the last 3 months on those quarters doesn't really surprise me, nor does it concern me, because I've got the 12-month data. But For instance, if you hired somebody and you thought that it should be able to affect your capacity and your ability to bring on more revenue, you're going to be able to use your words. It's going to be easier for you to see it on a shorter term basis. So the 3 months is a real good way to look at the decisions you've made recently. The changes you've made recently. Does that show up in the numbers? Because at the end of the day, that's what these numbers are for. Yes, we have to do taxes. Yes, we have to be compliant. We have to do those things. But the real value of these numbers is, are we doing the right things? We have a plan. Is the plan working? Now, Jeremy, you work with us on this on a monthly basis. What are your comments or thoughts on this methodology?
When I first saw this, because it's been a few months since I started working with you guys with this methodology, and I was actually blown away by some of this stuff, because conversations with clients before, I always really liked the income statement, like prior year 6 months versus this year 6 months, and like comparing year over year, but like really looking at each month sometimes and stuff like that. And this just kind of blew me away, as far as like the 12-month really make sure that you're going on the right path. So you can literally see that's going in the right direction. And if something was to turn, then you can look at some of the individual months or whatever. But for the most part, those 12 months are really giving you that, am I doing the right thing? Are we going in the way we're supposed to, that we're wanting to go? And same thing with the 3 months. Like you said, when you're looking at those short-term decisions and making sure that what you're doing right now is actually impacting that. Like the sales, we know that it goes down. That's fine. Our sales are on the rise for the last, with the trailing 12 months for sure. So that's definitely not an issue. But I absolutely love these kind of financials. They are very telling on looking at the trailing 12 months. I think it's awesome.
I'll give you another embarrassing story about Core. Jeremy and I were looking at this a few months ago, and he was like, "Man, the software expense is going down. That's great." And well, come to find out, and this is a true story. We had a software vendor that had not been sending us invoices for the last 3 months. Well, actually, he'd been sending them, but they didn't go through to our bill.com, and so they were missing. But that conversation of looking at that trend, Jeremy was like, "Hey, great, our software's costs are going down," and I'm like, "It shouldn't." And yeah, if you were looking at a trailing 12 months by month and looking at each column and say, well, oh, software's down this, and this, you can see it there too. But I think that this is just like, it jumps off the page to you. It's like, oh, that doesn't make sense. And I think one of the premises behind that is, if you think about it, day to day, month to month, your business doesn't change that much, right? Even if you've got growth plans and you're hiring people and all of that, things are pretty static. 80% of what you do are the same every month. So anything that's out of the ordinary is going to pop off the page at you here. Anything else on this methodology?
No.
Okay.
I love it though. I do love it.
I like looking at I like looking at the comparative to the prior year, but for a different reason. I like to look at it as how much progress we've made. Like, oh, we were here last year, and now look at where we're at.
Yeah, like that's kind of like a more of a scoreboard thing. This is like real time. Are we going in the right direction?
100%.
Yeah,
100%. Exactly right. So we are done with the presentation portion. I will open the floor to questions and answers. and put up the final slide while you ask those questions of Jeremy's lovely face and my fat face without a beard. Did you notice that?
Well, that was the start of the beard there. Little goatee.
So as I'm waiting to see if there are any questions, don't forget, if you want access to the Profit First University videos, email us, we'll hook you up. If you want help in developing your forecast, please email us. That's what we're here for. We'd love to help you. And if you've got a budget and you want to turn it into a forecast, don't know where to start, you know, whatever, wherever you are, we want to be able to help you. So no questions. I will wave till the camera until we end. TTFN.